Start sharing my screen. What do we want to look at?
Join us for Live from the Pit, where we deliver high-energy trading insights. Experience live preparation and execution with real trades and actionable
Only
steps.
something I don't know.
Trade smart, not impulsively.
It's pretty easy
Expect
for me.
precision and discipline in every move. Watch the charts, feel the momentum, and make informed decisions.
Something
Join
that
us daily
isn't
at 9
involved
a.m.
with
and
trading
become a
a
confident trader without the
range
noise.
market.
Subscribe to @Pitbull Traders on YouTube and
Everybody okay today? Trade-wise?
I haven't traded. I have no desire to trade this.
Yeah.
Yeah. Okay, so we can look at, so last week, let's look at corn. We talked about different contracts, different new crop versus old crop, the spreads between new crop and old crop. And, so some options I was looking at this morning would be against new crop, so against the December contract, but expiring. The typical December contract, which is the harvest contract, it would be December corn expires November 20th. But when you do some of these strategies I like doing, like call spreads, where you're buying a call and you're selling an out of the money call. So you're not getting unlimited upside, you're getting a range of upside. So the price goes up into that range, but then you still have this. If you want to get out, you've got to buy back this. There's a bunch of trucks honking outside. So you've got to buy back this call that still has quite a bit of time value. But when you do the short dated ones, you can kind of pick your for corn. And this is kind of what goes into some of these thoughts. Yeah, so typical seasonal pattern for December corn would be to kind of peak in June. Can you hear that? Can you hear those trucks? Yeah.
Yeah.
There must be some kids outside honking. So that's kind of why I like these short dated strategies. So 51 days left, that could be perfect, or it could be a little bit too short. So I was looking at some call spreads against the September short dated, expires August 21st. So that gives us like the full range of that summer kind of weather seasonal pattern. And I was looking at like a 5:30 call, buying a 5:30 call, selling a $6 call. So it gives you 70 cents of upside. And the cost on that would be 10 and a half. So the bid, I don't know if everyone's familiar with this, the bid's at 10, offers 10 and a half. So if we went to the market on that strategy, it would cost 10 and a half cents. You can maybe work it for 10 and a quarter. So that gives you a window of upside. So you're buying one call, you're selling another call. It's called a call spread. We could also, this is just what I was looking at to keep it simple. So then in theory, you could also, let's say we get back up to those highs, say we make new contract highs because of weather or whatever reason, and we get to 520. So you've got your, let's just say we get to 530. The market, so you're making money from 530 up to 6. And right now the market is at 490. We're at 491 in December. So let's say we get up to 530, and then we could spread it off again and make it into a call ladder, where we're selling another call. And I don't know why it defaults to 3. So let's just say we get up, we sell another, I don't know, 620 call to cheapen it up. So right now the 620 call would be, 4.5. But in theory, it would be out of the money at the time. But let's just say, we get that for, I don't know, 6 in theory. So now we've turned that trade from a cost of 10 cents to a cost of 2.5. We've sold it on the rally. But now we have risk that this is called a call ladder. So risk that we could lose money if it goes above 685. So we've cheapened it up. And so there's, times when you may work your way into a strategy where you're doing the full strategy at one point in time. And then there's other times where you may leg into it. You may want to buy the call right now because we've had a pullback. And then, spread it off and sell that upper call whenever the market rallies back up. But the risk of that is you're wrong and you have the full cost of that option strategy, and then it never rallies back up and you don't get the chance to sell that higher call. So legging into options, just like you would leg into like a futures position or scale into it. So now we're long 1 and we're short 2. They're at 2 different strike prices. And we can see our value. So the red is kind of like theoretical value today with the volatility and the time value, etc. But if we go and let's just say, these have 107 days left. Let's do like 90, just kind of step them down, 60 and 30. So the market moves closer to that intrinsic value, full value, as that time value comes down. You don't get, there's still a huge, probably like 60% of your value is still left on the table. Let's see if I can make that bigger. Even with 30 days to expiration. So you've got to get sub 30 days to expiration. Let's do like, 10 days. And you're still leaving quite a bit on the table through expiration. So that's the challenging part, is the timing on the options and how to unwind them. You're very seldom going to unwind them for full value until you get to expiration, and then you still have time working against you. It's a timing issue. So, so that's something that just looking at some upside. What else do you want to look at, Dani?
Well, does that, I do have a question. So if you're looking at it and you're leaving X amount more, still a chunk on the table before expiration, are you looking at it to then add more to the ladder? Or
if you're adding more to the ladder, no, because you're just taking more risks. So, let's look at.
nothing like me asking to take on more risk. What?
Okay, let's just bring up a chart of these corn.
And so obviously this is CQG, but what windows have you pulled up for the data to be looking at? What are
for the seasonal pattern?
Well, the seasonal pattern was the website that you go to, and then on your CQG, the actual when you're searching for the windows to get the call put.
Oh, I go to options, and then options strategy analysis.
Okay.
And then you build it out.
Okay.
And okay, so here's D's corn, and we tested $5 when crude rallied, 498.5, sold back off, took out that high, got up, broke through 5. So today is Wednesday. Monday was the first day that we closed above 5, 504 and 504 and a quarter. Got up yesterday and then backed off, but still closed. We closed at $5 even. So still closed above 5. Then we had crude today. So, who knows? Do we get a bigger pullback back down to like 480, or do we sell off further? We don't know. But let's say we kind of continue this trend and we're up here at, I don't know, 515, 520. Or let's say this has 107 days left. So let's say we're actually at 580 and we have 30 days left in our options.
Okay.
What percent of trading is options versus future? It could be majority options at any given time. So it could be quite a bit.
Yeah, mine are not. I'm only futures.
Yeah. So let's say we're at 580 and you've got upside from 530 up to $6. And the market's at 580, you've got 30 days left. So above 6 with the original strategy, you're not losing anything. It's just maxed out. You don't participate. You max out that value above 6. You don't participate in the market above that.
Yep.
But, you still have 30 days left. Let's clean this up a little bit. So
Manny said the less he trades options, the better he does.
So we're at 6, and in theory, your strategy's worth, 3,000 maxed out, but right now you're only at 2,000. So you're leaving quite a bit, 40% on the table.
Mm-hmm.
And you're on, you could get up here and say we sell that's the hardest part with the options. It's getting out. There's no good way to capture that full value until expiration without taking additional risk. So the point of taking options is to have less risk. And so to max that out, you're going to take a haircut somewhere. You're either going to not get the full value or you're going to have to take a risk.
And that all depends on all the Greeks, right? Time,
yes.
ball.
Yeah.
Mm-hmm.
Depends on, all the things. So you could do the strategy for, 2 cents right now. It's not trading at 2 right now, but this is settlement price where we were yesterday. So you could do the strategy and get own upside for very, very cheap. So you've got your downside risk is just the cost of what you paid for it, but your upside risk, you're going to take risks that you potentially lose money if you go above 685. So that's the hard part. We get up here and you want to capture this equity that you've got, and it gets hard to do that.
Then don't you just go back to your plan and say, hey, Like, this is what I wanted in the first place. If I'm going to make that, I'm content.
Yeah,
with
you either keep it on and let the market work, or you get out and you capture 85% of it. You could also roll up that put. So at this point, you've got equity made if the market goes up. Your risk, not so much that the market keeps going because you just get maxed out. You don't participate. But more of your risk is that the market goes back down and you lose that equity. So what you could do at that point is you could roll your 530 call up to like a, so when we're rolling calls, what that means, I don't know that I can show you on this quite as easily, but you're long the 530 call, and that's got, good value in it because it's deep in the money. Where you're long, you on that call from 530, we're at 580. So it's got at least 50 cents of intrinsic value. So you would sell the 530 call and spend some money to buy a, $6 call or 680 call.
Okay.
580 call, sorry. So you're capturing that equity, taking it off the table, and then spending a little bit of money to still participate if the market keeps going. Do you want to look at some equity options? We want to stick in there?
Let's do it.
Okay, is that easier? So let's go to
Anybody have any questions? Is this making sense to people?
Okay, so like options that expire today. Today's May 6th. Actually, let's go back to this. This is that strategy.
Yeah.
So you can see the open interest here on, where the biggest open interest is for these strike prices.
Mm-hmm.
And so the theory a lot of times is that the market goes to where that open interest is. Not
so similar to market profile, right?
Mm-hmm. Yes.
For those of you looking at market profile on futures.
Yeah. So these are your calls. These are your puts. Let's see if I can make it bigger. So we've got a pretty large open interest in 0 DTE calls at 75.45. So okay. Don't think we get up there today, but at the money, 73.70. Yeah. So I mean, okay, there's a ton of volume right there, ton of open interest up here. Do with that what you will, and then there's probably an easier way to chart this into, like, I'm sure, 100% certainty somebody knows like the weighted average volume of these strikes, but I just kind of look at it. Good enough. So 7,300. $73.90 to 85. So on the put side, and there's 72.25. There's just not much on, a lot more open interest on the call side than there are on the puts.
Well, Laura, I mean, hold on one second. If people don't know much about options, or there are people in the room that don't know much about options, maybe talk about like at the money, out of the money, in the money.
Okay.
Like very basic.
So at the money is, at the market. In the money would be, has intrinsic value. So like a put makes money when the market goes down. So if we're at 7,300 for easy math, then a 7,400 put is in the money. So you wouldn't go up and buy today 7,400 put right now. That's in the money because you're just paying for that difference. It's going to cost you. In the money is going to be more of like, I bought a put. We're at 7,300. We're at 7,400. I'm just making up numbers. We're at 7,400. I bought a 7,300 put Now the market came down to 7,200 and my 7,300 put now is in the money. Out of the money is going to be, away from the market. So your really strategy there is that you're buying something fairly cheap and then the market's moving and making it profitable. So like corn, if you're buying calls, you're gonna be buying them out of the money, and then hoping that the market goes up there and turns them to in the money options. At the money, you can always look and see, let me see where ES is at right now, 73.68. So 73.70 is at the money. And the last, it says the bid, bid ask 670 to 7.
So usually at the money, the price will be the most expensive, right? As the delta, the weight it carries will be closest to 100 because it's at the money, correct?
Yes, because it's catching up on the intrinsic value.
Yep.
Kind of maybe easier to visualize on corn. Let's go back. Okay, so July corn or even December corn. Let's go to December corn.
Yeah, Slatitude, I guess that's how we'll call it. Slatitude. I love options and the concept of options. I think I'm opening my brain more up to the strategies and executing them, but I started in options and it's taken until this period of time in my life to actually want to execute them. So it takes time. It just takes time.
Mm-hmm. Let's talk about visualize something here on corn because it's a little less noisy than the 0 DTE options. And then we'll look at some equity options for Manny's question.
Yeah.
But December, we're at 490. So an at the money option is 490 put and a 490 call. So if we visualize this, so you can see what's the market telling us, number one. So if we buy a 490 put, at the money put, and at the money call, that would cost 76 cents. So the market is telling you, the market's not going to give you anything for free. The market's saying that it's predicting a 76, 75 cent range on corn. So your wing risk, wings would be, outside of that range. It would have to move, above 560 or below 412 for the market, for that option strategy to pay you that. So market makers, someone is selling, it's called a at the money straddle, the put and the call. So you're either buying it or selling it. So buying.
How do you get the value of the wings? I forget.
What?
How do you get the value of the wings?
Just the market's at 490 and the at the money straddle, which is the put and the call together, is 70. So right. If you're buying it for 70, let's just clear this. Okay. So, 490 plus 70 is 560 minus 70 is 420. So from 420 to 560, that's the range that the market's pricing in. So someone else is selling that, taking the other side. And they're betting and they're willing to take the risk that they're going to collect that premium. You're going to pay for that premium and the market's not going to move outside of that range.
I don't know what that comment was.
I don't know either. I didn't read the whole thing. So whenever you're looking at your strategy, what's cheap, what's expensive, that the at the money options are telling you what the market thinks is cheap and expensive.
Yeah.
So if we're going to sell in May and walk away, we would say we're doing it on the S&P. We want to make money to the downside. So we want to look at put strategies. So if we go here, we're at 73.68 because that's telling you the last price here. June options have 43 days left.
Oh no, that's sad.
And seems like not enough time, or just feels like it's going by fast.
Oh, no, he just said Ted Turner died. So,
Oh,
yeah, but no, keep going, Laura. Sorry.
okay. So they expired June 18th. 73.70 put at the money. 73.75 would cost 148 points.
That's a lot.
So let's visualize that. Yeah. So then it's got to get below 72.50 before you start making it making anything there. And it's got to do it in the next 43 days. So let's say we want to cheapen it up a little bit. Well, that gives us 100% downside protection. Do we need 100% downside protection, or do we want a range of downside? What do we want that range to be? And then how much do we want to pay for it?
Well, I'll tell you, I don't want to pay $150. That's for sure.
Yeah.
Or 300. Right.
Just say we do. So say we want to cheapen it up a little bit.
Yeah.
So we want to come out of the money a little bit, and we go down to like 73.25 to 72.25. We want $100 a downside, 100 points of downside. So now that would cost it's giving me an error, so something's not reading it correctly. For whatever reason. Okay, doesn't like that for whatever reason. But the 73.25 would be 130 points, and 72.25.
Okay, let me ask you this. Now, does it make more sense when you're starting out to think about your own strategy and what you think, or looking at the sheet and actually looking where the most volume is in the strikes to lean on? Because that's what we would do in futures when we used to be able to see the book, right? I'd go right to where whomever's out there, and that's where the high size is. I'm going to make my strategy around that because I'm leaning on that.
Yeah, I'm going to lean on that for picking my strike prices.
Yeah.
Like if there's huge support at this level, well, then I really just want to make money if it goes below that level. Because if it gets below that support, we probably have quite a bit farther to go. Or if there's huge resistance, well, especially if I'm hedging a position, I want to do that. If I think there's another leg coming up or down, if we get over that level, if we get over that hump where all that volume is.
Well, that's so interesting. So you're thinking outside in the way of a breakout, and I'm thinking like leaning into that level.
Yeah. Oh. Yeah. Where I want my window to max out at that level where it's got the highest probability of going to.
Cool.
Or if I'm going to pay for something, I want to pay you don't want to pay where it's got the highest probability of ending up, and then that just eats up all your premium. So for whatever reason, it's not liking the strategy, but you're buying the 73. Where are we at right now? 73.25 put, selling the 72.25 put, and you are doing that 72.25 put, let's just say 100 points. 73.25 put is 130. So you're doing that for 30 points to make 100. So it's cheaper, but I still wouldn't say it's cheap. Then you could get into the ladder. We talked about call ladders. You could do the put ladder and sell another put down below it.
I mean, even back to the basics of it. So if you're long a put, your actual intention is you're getting short the market, right?
Yes. You think the market's going to go down.
Yeah.
Yeah. And let's just look at a general chart. That's not what I wanted.
And vice versa for when you're selling a put, you think that the market is going up.
Yeah. So, where do I want my strikes to be? Let's make this bigger.
I want to look back on where the highest volume is and then build the strategy around that.
Yes.
Right?
And that also tells you like how much are you willing to pay for it?
Right.
What is cheap? What is expensive?
So let's say, we saw that the highest volume was around 75.25. And so I want to spend, let's say, less than $100 based off of that volume. I don't know what strategy I'm using, but
yeah. So here's your put ladder. You're buying the put, you're selling it out of the money put, you're selling it further out of the money put. So you're saying, I think we go lower, but I don't think we go to zero. And so I'm willing to take some risk for that. So we're buying the 71.25 put. And these are all I'm just making up strategies.
and this is intentional based off of Manny's question.
Yeah, it's his question.
Right, sell in May and go away.
Yeah, I'm not saying this necessarily what the strikes you should use. I'm just
right
around. Yeah. So with this, you actually bring in 43 points. So you're bringing in a credit, but you're taking risk if we go below 7,000. So let's look and see. Where did my quote board go? So 73.25, 72.25, 71.25. I don't know if you can see that.
So you're just like more concerned about some downside protection.
Yeah. So then you're maxing it out between 72.25 and 71.25 here. And then if it gets below 7,000, you're losing money. You're going backwards. So I don't know. That's not a bad strategy just for making something up.
Manny, did you write it down?
Yeah, bookmark it and come back and we'll follow up. So you're collecting that premium, but you're taking risk for that. There's going to be a margin requirement associated with this, and you have to carry that margin for 43 days. They have 43 days to expiration. So if you're wrong and we don't go down, then you collected that premium. It keeps going up. If you are right, you want it to go down to the maximum of this range. That's your thought process of what does right look like. Right would be settles in this max area. So that's what your bias is here. But for collecting that premium and for it being, it's not cheap is not the right word because you're bringing in premium, you're making money on the strategy. To give that up, you're got to take downside risk and it's a marginable position. So you are taking risks that we don't get below 7. You could also spread it off. So,
are you going to do this? It's very interesting to me.
When you're talking about risk reversal, what do you consider that?
So TO27, what do you consider your risk reversal? I forgot what a risk reversal is.
So you could spread off your wing risk by buying out of the money put, 7,000 put. And it would cost you 12 points. And then your maximum downside risk would be that $7 put kicks in. So there's nothing for free or cheap. Nothing for free. There are things for cheap, but you're going to have to give something up. So if you don't want to take that maximum downside risk that we get below 7,000, I don't know what it's going to do in the next 43 days. You've got to give something up for that.
I definitely would do that.
Hedge off your
Protect
downside.
myself on the downside. Yeah.
Yeah. You could also do that with like weekly options too. They're just not going to graph correctly because it's going to have a hard time visualizing that. But each week that it goes further and further without getting below that downside risk, your risk goes down. So, and I would probably You know, if we're looking at 73.25 to 72.25, I mean, we were there like 2 days ago, you know, so I would maybe want to widen this out. Yeah, I don't know. I'm just picking things. Okay, so in theory, you could do this for no cost. And when we say no cost, that means, yeah, it's not like in this. Maybe it's because I'm on demo. But this is off of yesterday's settlement, so it's probably different. You have to just play around with it today for live prices. But anyway, you know, no cost. If it goes up, you're not out anything. And if it goes down, you're losing money below 6,800 at this point. But you're going to have to hold that margin for the next 43 days. And you're just betting that we come down to, we sell off. If we don't, if you're wrong, you're not out anything besides, when we say no cost, that means no option cost, not necessarily no margin cost. So there is a cost associated with holding that trade, and that's your margin requirement. But if you're wrong and it keeps going up, you didn't spend anything on option premium. And that's, you have to take that risk for that ability. And then if it goes down, you know, you don't have unlimited downside. You just have, you max it out at 71.25. So, you know, 200 points. So you're maxing it out in this range, and then you're going backwards if we get below 6,800. Yeah. So not a bad strategy. It's just going to be margin heavy. For a bit more time, you're going to have to go against the September contract, which is fine. It's just at a different underlying price. Let's see what that looks like.
Should be less, right? Or no more?
Well, you're going to be farther away from the money. You're paying for more time value,
Right.
and you're farther away from the money because September's at 74.23 versus June at 73.66.
Oh, right. So technically it's more.
Yeah. So it's costing you more because you're farther out of the money.
Yeah.
But the same strategy, you know, you could either go closer to the money and get that, or you can make your wings farther out. So let's just say, where are we at right now?
I loved calendar spreads. Those were my favorite back in the day.
Yeah, so we can just, you know, really widen this out. Let's widen it out to, so now we've turned it into a 1x2. You're buying one, just kind of inadvertently because they're the same strike price. You're buying one put, it's not at the money because at the money would be 74.21, you know, and this is 73.50. So you're 75 points out of the money. We move that today, you know, and then you're selling 268 puts.
All set.
So all in the set. So let's just say we go down to like a, so this tool to me is really good. You can just visualize it and you can kind of play around with your strike prices. So this would cost you 36 points. You know, so it's got a small cost relative. And then if we get below 6,000, you are losing money. So pretty wide, but anyway. And then once you kind of look at the general, for me, looking at the full dated contract, I can visualize that better. And then you can go into the shorter duration and kind of play around. So let's say we wanted to do something that expires today. Let's have 0 days till expiration. They expire May 6th. 73.66 is going to cost you 7 points. And let's go back to and we don't need the continuation contract. So 10-minute contract, I don't know if you can see it that great, but you could do the same strategy. It's just your risk versus reward isn't necessarily there. When you start selling some of these, because it's like, I don't know what it's going to do by the end of the day. Where are we at right now? 73.65. So let's just say 73.60 put down to a 73.30 put. You know, do you really want to sell that for a 1.25? Probably not, you know.
I always felt like the $3 to $5 range was always a good trade.
Yeah. So to me, just looking at it, we're at 73.65. So at the money put and call are both 7.5 cents. So that's telling you it's expecting a 15-point range for the rest of the day. That doesn't mean that's what's going to happen. That's just what the market's pricing in right now. So that's what the market's telling you. Most likely, if you spend more than that, if you're expecting more than a 15-point range, you're probably going to be wrong, is what the market's telling you. So
it's fascinating because even if you don't trade options, you definitely can look at the options counters and again, lean on price, lean on volume to where the people think that the market is going to either way, and then also speccing in a range. That's fascinating to me.
Yeah. It's also probably useful to see like, okay, where do I want to be aggressive in taking profits?
Mm-hmm.
If I get 15 points made, you know, or at this point, 8 or 10, you know, which seems kind of counterintuitive after we've moved 80 points. We're up 80 on the day. We're up 79 right now, you know, that it's pricing in a narrow range for the rest of the day. You can also get some good deals. You know, if it does move out of that range, well, then you have the market makers that, yeah, they've sold these options and they're hedging that. They're not just taking full risk, just betting that it doesn't move and then taking the loss if it does. Once it does move, they're hedging that off.
Yeah.
With futures or with other options, things like that. So once it does move out of that range, the market's surprised, and then you can get bigger moves because it moved. Because the market then can, like, so say we sell off 20 points. Well, then they've got to sell futures. I don't know about zero DT options, but just going back to ags, if we move outside of that range, well, then they've got to hedge that off. So then you get further selling because they're hedging their risk. And then that makes the range get even bigger, or vice versa on the upside. So they're delta hedging against that. So that can push your range bigger.
Essentially, it's the comparable to blowing stops.
Yes. Yeah.
Mm-hmm. Yeah. So this is awesome. Thank you.
You want to talk about some mindset?
Sure.
Okay.
That would be great.
Let me stop sharing.
That was awesome, Laura. Okay, guys, you can see my window.
Mm-hmm. Yeah, we can see it.
That's funny. I mean, who has a Sears catalog anymore? That's amazing that you even have one. Okay, you guys, so we're back to everything that we're going to address in mindset. I'm going to put into the Trade Anchor's website. So when you log in, now let me just preface the fact that this is for educational purposes. If you're curious about your evolution and self-actualization, by all means, these are tools. This is not replacement for any kind of medical assistance. If you are calling for that, or if you need that, you need to work with a doctor. But certainly, these are tools that help me. So, okay, so I'm just gonna sign out so we can start all over. This is locally stored, so I'm working on giving an import-export JSON file so that you guys can import the data if you lose your data. I just haven't decided what I want to do on a database, kind of pushing that out for right now. Okay, so basically look at for the changes. I've added quite a few things and condensed quite a few things through the worksheet itself. But most importantly for today, and I've broken all the topics down for strength, flexibility, stability, and endurance. So you can poke around what I've put up there. But for today, I wanted to address some, we thought we'd address some breath work because I heard somebody talking about it in Manny's group. And I thought maybe I should address it because it is so pertinent and I use it every day. We'll run through 4 different exercises and I've put them on the website so you can use that at any point in time. You can look it up on your own time. Again, you can use it today, tomorrow, and hopefully this will exist in 10 years from now. So, yep, deep belly breaths for certain, they work too. But for starters, it actually is just counting the time your breath counts. So if you inhale for 1, exhale for 1, inhale for 2. So inhale, count 2 counts, exhale for 2, inhale for 3, exhale for 3. So you're matching your breath counts on the inhale and the exhale. So you can certainly use the counter. You can see how it goes. If you want to use the counter and then reset it. And then the second one I put up there are count breath cycles. So this one I used to do when I was running, and breath work to begin with was really important when my dad used to teach his education programs. But the count breath cycles were if you inhale, exhale 1, inhale, exhale 2, inhale, exhale 3. And so you're just going up until you lose count, and then you start over once you've lost count. So you can actually do it with a counter, or you can do it yourself. Like let's say, okay, I lost count at 20, and I know that 20 is my max right now. So maybe tomorrow I'll try and get 25 or go to 30. Making sense so far?
Mm-hmm. Yeah, this is cool.
Okay, so box breath is really an awesome breath work tool. It's 4 counts, so 4 seconds per inhale, exhale, but this time there's a hold in between, both after the inhale, after the exhale. So if you inhale for 4, hold it for 4, and then exhale for 4, hold it, and then inhale for 4. The hold after the exhale is always the most difficult. Because it's on an exhale rather than an inhale, but it really is a powerful tool to use. So if you think of a box, so your inhale, hold, exhale, hold, inhale, hold, exhale, hold, and 4 counts. Okay, so, and it'll run through if you go through the timer.
It's a long 4 seconds, especially when you see it.
Yeah, for sure. Yeah, I thought about doing a 1-to-2 ratio on inhale, exhale, but that's advanced and we'll get there when we get there. This is probably my most favorite of all breathwork exercises, beyond deep belly breaths and breathing into your chest, your solar plexus, and then your belly to get through the spine, which I can address later too. But this is alternate nostril breathing. And what you do is you take your right thumb, you hold your right nostril, and then you take your ring finger and you'll hold your left nostril, but then release your ring finger, and you inhale through your left nostril, hold it, and then exhale out your right, and then inhale in through your right, hold it, exhale out your left. So you're always exhaling and inhaling on the same side and releasing. And then, of course, you can go through cycles of that. That's my most favorite. I think I get the most value and connection. But it's a tool for you guys to use. Any questions here?
You lost me on that one.
This one?
Yeah.
Okay. Okay. So take your thumb to your right nostril and take your ring finger to your left nostril, but don't squeeze your nose just yet. Okay. Now press your right nostril in with your right thumb and inhale through your left nostril. Then close it with your ring finger. Exhale out your right. Then inhale through your right. Close it. Exhale out your left. Inhale through your left. Close it. Exhale out your right. So you're actually tapping into the hemispheres, your left and right hemisphere of your brain. I always feel real energized after I do that one.
Mm-hmm.
And you know, the intention with breath work is really to bring you back to a grounded state and a present state. So if you find yourself at the screens and you're just mechanically doing your habitual work, but then you fall into that zone where you're just executing your trades and you're not paying attention, you're
clicking away.
Yeah, you're just clicking away. The easiest way to, besides letting go of the mouse or your keypad, whatever you're trading off of, is to stop, let go, and then come back to your breath. Beyond that, what would be also most easiest is to get you back into the present moment outside of walking out of your office, is to look in your office and start naming things in your office or wherever you're trading, so that you can connect your eyes visually to exactly what's in the present moment outside of the screens.
Can you go back to the first slide?
First slide?
Yeah.
This one?
Mm-hmm.
Yeah, so this is just breath count. So inhale for 1 second, exhale for 1 second. Inhale for 2 seconds, exhale for 2 seconds. Inhale for 3 seconds, exhale for 3 seconds. Inhale for 4. Yeah, the power of now is oldie but goodie for sure. For sure, Manny. Yeah. But certainly, like I've said before, I mean, this is as much as I'll put on the website for Laura and I think before we start breaking it down into tiered paid tiers. But this is, you know, things that I think that are pretty important. The monthly tracker is something new that we added, where you can list your account. Did you follow your rules for this one? Did you not follow your rules? What was your P&L? How much did you trade? And if you wanted to write notes. If you have multiple accounts, more than 2, then you obviously can add the other one. You have your yearly goal, your monthly goal, your weekly goal, your daily goal. You can print it. I think if there's tools that you guys need that I haven't put on here that Lauren hasn't addressed, and we haven't thought of together, then by all means tell us, and of course we'll add it. Does everyone feel comfortable about the breath work?
I'm guessing it's something too that takes practice. Like the more you do it, the easier it gets. Yeah.
Yeah, I would suggest, by no means is this homework, but I would suggest if you can attach yourself to one of them, one exercise, and work on that for the next week, because I will ask how it went next week. But give it a shot, see how you feel, see if it changes your outlook. You know, let's say you're having a bad, open Or maybe you're having a tough time with a family member and you do some breath work and see how that alters your state of mind and your state of presence and how you can really deal with the challenge at hand. By coming back, I mean, your breath is the most, talk about no cost tool.
Yeah.
We have.
Yeah. I'm just thinking about doing it like after I pick the kids up from school and everyone's going 20 different directions and your brain's still thinking about the markets and you're still thinking about all the stuff you still need to get done. And then they're asking you like if mermaids could get into an underwater volcano and you're like, I don't know that, but.
Love that though. I mean, you may even find, while you're even trading, it's those moments that you catch yourself, whether you're trading or you're in the moment where the girls are asking you about volcanoes and mermaids, that you take a big breath and you sigh. You're like, oh. You catch yourself on that big inhale, exhale, and that's when breath work really actually would be beneficial, right?
Yeah.
Because you're holding your breath. I mean, you're obviously breathing throughout the day, but if you take a deep sigh, which those feel awesome too, but that is a cue to you that you probably could use some breath work throughout the day. For me personally, I do it right when I wake up. I put on my red light mask and then I meditate and then I do my breath work before I get out of bed.
Mm-hmm.
So that works for me.
Yeah, I'm going to work on incorporating some of that into my routine.
And deep breath, belly breaths work as well. I mean, it's a good one too. Anything
not like there's not really right or wrong. Yeah.
Nope.
I think you and Manny just became best friends. Didn't even realize it today.
Yeah. I love mine. I don't go a day without it. So, but again, if you guys have questions, let us know. For mindset, let's keep this to the breath work. Next week, Laura, are you going to be here?
No, I'm going to be gone next week.
Okay.
So do you want to run the room or do you want to skip?
Yeah, no, I'll do it because I'll do, if you guys are open to it, if you want me to, we'll go through mind movies and visualization. Does that work?
Yeah, sounds great. Okay, well,
awesome.
We'll wrap it up. Let's see if we move out of that 15-point range between now and the close. I haven't looked to see where we're at, but
58.
Yeah, looks like we are.
Yeah,
so those options would have been cheap on the put side.
Next time.
Yeah.
Thanks, everybody. Have a good one.
Thank you. Bye.
Bye.
In a market built for machines, where the odds feel stacked against the retail trader, one firm is turning the tide. Welcome to Pitbull Traders, the next generation in trading. This is more than just an evaluation. It's a development ground, designed to sharpen your edge, build your discipline, and back your growth with real capital. With affordable evaluations, clear rules, and a structure built to reward consistency, Pitbull Traders is here to help serious traders level up.